leaves, and they think they hear the market rattling too. They see the headlines getting a little more frantic, and they want a prediction. They want the secret. Well, here it is. This is what you came for. The single most important thing you need to know about what's coming in October is that everyone asking that question is already losing the game. They're standing on the wrong side of the field, looking at the wrong scoreboard. You see the financial industry, the television commentators, the newsletter writers, the folks who get paid when you buy or sell. They have you convinced that investing is about predicting the future. They want you to believe that success is about knowing whether October will be red or green, and it's a frustrating, nerve-wracking way to live. It keeps you up at night. It makes you check your phone every 5 minutes. It's a common problem, and it's built on a complete falsehood. The solution, the real secret, isn't about predicting the rain. It's about building an ark. And for the next little while, I'm going to give you the blueprints to that ark. I'm not going to give you a hot stock tip. I'm going to give you something far more valuable, a framework for thinking that makes the month on the calendar, whether it's October or April or July, almost completely irrelevant. This isn't just my opinion. It's the bedrock of a philosophy that I learned from my teacher, Ben Graham at Columbia. And it's a lesson it's been proven out over 70 years of recessions, booms, busts, and panics. What I'm about to tell you is how to turn fear into your friend and volatility into your opportunity. And a little later, I'm going to lay out the exact step-by-step process you can follow to prepare not for October, but for your entire financial life. So let's talk about this obsession with October. It's not an accident. History has given us a few good scares in the 10th month, 1929, 1987. The word itself carries a psychological weight. The media knows this. They understand that fear sells. A headline that says stocks may be volatile in the coming weeks gets ignored. A headline that screams, "Is Black October coming again?" gets clicks, it gets eyeballs. It gets you to tune in after the commercial break. They are not in the business of making you wealthy. They are in the business of selling advertising. And nothing grabs attention like a good ghost story. The fundamental mistake is treating the stock market like a casino or a weather vane. People look at the ticker symbols flashing by on a screen, red, green, and they think that's the game, but it isn't. You are not buying a lottery ticket. You are not betting on a number. When you buy a stock, you're buying a fractional ownership interest in a business, a real business with buildings, employees, customers, and products. I want you to really let that sink in. You are a part owner of a company. Now, imagine you owned a piece of the best farm in your county. It has rich soil, a reliable water source, a smart and honest farmer managing it, and it produces a healthy crop year after year. Now, let's say you have a neighbor, we'll call him Mr. Market. Every day, Mr. Market comes to your door and shouts a price at which he's willing to buy your share of the farm or sell you his. Some days he's euphoric. He's seen a sunny weather forecast and he'll offer you a ridiculously high price for your land. Other days he's terrified. He read an article about a potential drought 1,000 miles away, and he's in a panic, offering to sell you his share of the farm for far, far less than it's worth. Is the value of the farm changing that dramatically day to day? Of course not. The soil is still rich, the water is still there. The long-term earning power of that farm is stable. The only thing that's changing is your neighbor's mood. The stock market is Mr. Market. It is there to serve you, not to instruct you. You don't have to listen to his frantic shouting. You don't have to sell when he's scared, and you certainly don't have to buy when he's greedy. You get to decide. You can take advantage of his moods, buying when he's pessimistic and offering you a bargain, or you can simply ignore him, tend to your farm, and let it produce its value over time. So when people ask, what's coming in October, they're really asking, what mood will Mr. Market be in next month? And my answer is always the same. I don't know and I don't care. What I care about is the long-term productive capacity of the businesses I own. The secret isn't knowing Mr. Market's mood. The secret is knowing the value of your farm so well that his mood becomes irrelevant, or better yet, an opportunity. This brings us to the first and most important pillar of sound investing, understanding that you are buying a business, not a stock, not a ticker, a business. Before you put a single dollar into a company, you should be able to explain in simple terms that a fifth grader could understand exactly how that business makes money. What does it sell? To whom does it sell it? What is its...
I was thinking I had cancer. I thought I didn't have much time. The only thing that gave me some peace was that I had this great Guardian life insurance.
Competitive advantage that allows it to charge a fair price and keep customers coming back. If you can't answer these questions, you aren't investing, you're speculating, you're gambling, and you're leaving your fate in the hands of Mr. Market's emotional whims. Let's get into the details of how this works. Think of a company you know, maybe it's Coca-Cola. How does Coca-Cola make money? Well, they sell syrup concentrate to bottlers all over the world. Those bottlers add water and sugar, put it in cans and bottles, and sell it to stores, restaurants, and vending machines. Coca-Cola spends a lot of money on advertising to make sure that when you're thirsty, the first thing you think of is their product. Their business is the combination of a secret formula and a powerful brand name that exists in the minds of billions of people. The desire for a Coke on a hot day is their primary asset. It's an intangible, but it's the most valuable thing they own. That mental real estate is what drives their earnings. Now, does a potential recession in October change that? In the short term, maybe a few less people buy a Coke, but over the next 10, 20, 30 years, are people going to stop drinking it? Very unlikely. The fundamental economic engine of that business remains intact. Or take a railroad like Burlington Northern Santa Fe, which we own at Berkshire Hathaway. What is their business? They move goods. They move the grain from the farms in the Midwest to the ports. They move the coal to the power plants. They move the consumer goods from the ships in California to the warehouses in Chicago. It is the circulatory system of the American economy. It's a very capital-intensive business. You have to lay down thousands of miles of track and buy locomotives. But once that track is there, it's an enormous competitive advantage. It's very difficult for a competitor to come in and lay a second set of tracks right next to yours. So when I think about the railroad, I'm not thinking about what its earnings will be in the fourth quarter. I'm thinking about what the American economy will look like in 2030, 2040, 2050. As long as America grows and people need to move goods from one place to another, that railroad is going to be an incredibly valuable asset. The noise of any given month is just that, noise. The sound of the locomotive rolling down the track for decades to come is the music I care about. This business-first mindset is what protects you. When you see a headline that the market is down 500 points because of some news out of Washington or China, your first thought shouldn't be, I'm losing money. If you own good businesses, your first thought should be, did this news permanently impair the long-term earning power of the companies I own? 99 times out of 100, the answer is no. What's happening is that Mr. Market is in one of his panics again, offering you the chance to buy more of those great businesses at a cheaper price. And I promise you in a few minutes I'll explain exactly how to identify those bargain prices. This leads us to the second pillar, which is the single most important concept in investing, borrowed directly from my mentor, Ben Graham. It's 3 words, margin of safety. A margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. It's that simple. If you calculate that a business is worth $1 per share and you can buy it for 60 cents, you have a 40-cent margin of safety. It's the cushion that protects you from bad luck, bad timing, or errors in your own judgment. As Ben said, the purpose of the margin of safety is to make a precise estimate of the future unnecessary. Think of it this way. If you're building a bridge and you expect the heaviest truck that will ever cross it to be 10,000 pounds. You don't build the bridge to hold 10,001 pounds, and you build it to hold 30,000 pounds. That's your margin of safety. It protects you from unforeseen circumstances, a heavier than expected truck, a flaw in the materials, a bit of erosion under the foundation. Investing is the same. The future is never certain. You can do all the research in the world, and you will still be wrong sometimes. A new competitor might emerge. Technology might change. A management team might make a mistake. The margin of safety is your bridge. It's what ensures that even if things don't go exactly as planned, you don't lose your shirt. So how do you figure out this intrinsic value? This is where we get into the nuts and bolts. Intrinsic value is simply the discounted value of all the cash that can be taken out of a business during its remaining life. That's it. It's an estimate to be sure, but it's an educated one. Let's break down that definition. Cash that can be taken out of a business. We often call this owner earnings. It's not the same as the reported profit you see in the headlines. To calculate owner earnings, you take a company's net income and you add back non-cash charges like depreciation and amortization. Then you have to subtract the average amount of capital expenditures the business needs to spend each year just to maintain its competitive position and its unit volume, the maintenance capital expenditure. What's left over is the real cash profit that the owners could, in theory, put in their pockets each year. A business that reports $1 billion in profit, but has to spend $1 billion on new equipment just to stay in the same place isn't really making any money for its owners. A business that reports $1 billion in profit and only has to spend $100 million on maintenance is a cash machine. that's the kind of business you want to find. Once you have an estimate of the owner earnings for the next, say, 10 or 15 years, and a guess at a terminal value after that, you have to discount those future earnings back to what they're worth today. A dollar you receive 10 years from now is worth less than a dollar you have in your hand today. Why? Because you could take the dollar you have today and invest it, earning a return. So you use a discount rate, usually the rate of return on a long-term government bond, which is considered a risk-free investment, plus a little extra to account for the risk of owning a business. Now, this sounds complicated, and the truth is the precision is a mirage. Anyone who tells you the intrinsic value of a company is $81.47 is kidding themselves or trying to kid you. The future is too uncertain. That's why the concept is more important than the calculation. The goal is not to be precise, but to be approximately right. You're looking for businesses where the value is so obvious and the price is so low that you can be sloppy with your math and still know you're getting a bargain. I look for 1-foot hurdles I can step over, not 7-foot bars I have to leap over. If you have to pull out a calculator and do complex algebra to decide if something is a good investment, the answer is no. The great opportunities are usually staring you right in the face. They are wonderful businesses run by able and honest managers that, for one reason or another, a bad headline, a temporary industry downturn, a general market panic, like we often see in October, are selling at a significant discount to their long-term value. This is what allows you to be greedy when others are fearful. Your greed isn't an emotion. It's a rational calculation. While everyone else is panicking about what's coming in October, you have done the homework. You have a list of great businesses. You have an estimate of what they're worth. And you see Mr. Market in his manic fit offering to sell you a dollar bill for 60 cents. You don't have to predict when his mood will change. You just have to know a bargain when you see one and have the courage to act. The margin of safety is what gives you that courage. Now, which businesses are most likely to have this durable, predictable earning power that makes calculating a margin of safety possible? This brings us to our third pillar, the search for a company with a durable competitive advantage, or what I like to call an economic moat. Think of a medieval castle. A strong castle has thick walls, high towers, and loyal defenders, but the most important feature is the wide, deep moat surrounding it, filled with crocodiles. That moat is what keeps the marauding armies, the competitors, at bay. It allows the castle to prosper in peace. In business, the castle is the company's profitability, and the moat is its sustainable competitive advantage. It's what protects those profits from being competed away. I want to buy a wonderful castle, but I'm only interested if it has a great big moat around it. And I want a knight in charge of that castle who is honest and able and whose goal is to widen the moat every single year. These moats come in a few different forms. Let's talk about them in detail so you know what to look for. One of the most common is an intangible asset, like a brand name. I mentioned Coca-Cola. That brand is a moat. For over a century, they have spent billions of dollars creating a positive association in people's minds. When you see that red and white script, you think of,
in this game, you bet on streets and aim to beat the pay table. So, shall I wait for you at my table? Mississippi WSOP, the river of big wins.
Happiness, refreshment, sharing, a new company. Bob's Cola could have a product that tastes identical and they could sell it for half the price, but they wouldn't be able to dislodge Coca-Cola. The moat is too wide, the brand is too powerful. Another moat is a network effect. This is when a product or service becomes more valuable as more people use it. Think of American Express. The more people who carry the card, the more merchants want to accept it. And the more merchants that accept it, the more people want to carry the card. It's a virtuous circle that creates a powerful moat. A new credit card company would have a terrible time breaking in. They can't get customers without merchants, and they can't get merchants without customers. The established network is the moat. A third type is high switching costs. This is when it's a real pain in the neck for a customer to switch from your product to a competitor's. Maybe you're a large corporation and all of your data is run on an Oracle database system. Even if a competitor comes along with a slightly better or cheaper product, the cost, risk, and headache of migrating your entire company's data is enormous. So you stick with what you have. That inertia, that difficulty of switching is a moat that protects Oracle's profits year after year. Finally, you have a cost advantage. This can come from scale, like Costco. Because they buy in such massive quantities, they can get better prices from suppliers than anyone else, and they pass those savings on to their members. It's very hard for a small grocery store to compete on price with Costco, or it can come from a unique process or location. Geico, in its early days, had a cost advantage by selling insurance directly to government employees, bypassing the expensive agent network. That was their moat, and it allowed them to offer lower prices and take market share for decades. When you're looking at a business, you have to ask yourself, what is the moat? Is it getting wider or narrower? A company with a wide and widening moat can fend off competitors, maintain its pricing power, and compound its earnings for a very, very long time. This is the kind of business that can weather any October storm. Recession might temporarily lower its sales, but the moat ensures that when the economy recovers, its customers will still be there. Its competitive position will be intact, and sometimes it will even be stronger because weaker competitors without moats may have gone out of business. So to recap where we are, we've established that the question isn't what's coming in October, but which businesses are so good that October doesn't matter. We've defined those businesses as ones you can understand that have a durable economic moat and that you can buy at a significant discount to their intrinsic value, a margin of safety. This framework is simple, but it's not easy. It's not easy because it requires a certain kind of mindset, a specific temperament. And this is the fourth and perhaps most crucial piece of the puzzle. Investing is not a game where the guy with a 160 IQ beats the guy with the 130 IQ. It's a game of discipline and emotional control. You need a temperament that derives pleasure from inactivity. Most people feel like they need to be doing something all the time. They see the market moving and they think they need to buy or sell. They get antsy. But in investing, the big money is not made in the buying and the selling, but in the waiting. It's made by buying a great business at a fair price and holding it for years and years, letting it compound. I have an image of a punch card with only 20 punches on it. Every time you make an investment decision in your life, you have to punch a hole. With only 20 punches, you would think very, very carefully about each one. You'd wait for the absolute best opportunities, the no-brainers. You wouldn't swing at every pitch. You'd wait for the fat pitch right down the middle of the plate. That's the mindset you need. Most of the time, the smartest thing to do is nothing at all. This requires patience, and it requires a certain humility. This humility is expressed through another key concept, the circle of competence. Each of us, through our life experiences and studies, has built up knowledge in certain areas. Maybe you're a doctor and you understand the healthcare industry. Maybe you're a software engineer and you understand technology. Maybe you're a farmer and you understand agriculture. These areas make up your circle of competence. Inside that circle, you have a good chance of knowing which businesses have moats and which don't. Outside of that circle, you're just guessing. The size of your circle is not important. What's vital is knowing where the perimeter is. Tom Watson, the founder of IBM, said it best: "I'm no genius. I'm smart in spots, but I stay around those spots." During the tech boom of the late 90s, I was criticized for not investing in tech stocks. The truth is, I didn't do it because I didn't understand them. I couldn't look out 5 or 10 years and have any confidence in what the competitive landscape would look like for hundreds of these new companies. I couldn't figure out their intrinsic value, so I didn't play. It wasn't my game. It was outside my circle of competence. It cost me some gains in the short term, but it saved me and our shareholders from the devastating crash that followed. So before you invest, ask yourself, is this business inside my circle of competence? Can I truly evaluate its long-term prospects? If the answer is no, then close the book. Move on to the next idea. There are thousands of companies out there. You only need to find a few good ones in your lifetime that you understand well. Finally, the most important temperamental quality is to be able to think independently. When you buy a business, it should be because your research and your analysis have led you to believe it's a good investment. It should not be because your neighbor told you about it, or because you saw a talking head on television get excited about it. You must be able to operate in a way that you are comfortable with your own judgment, even if it means being the only one at the party who thinks so. In fact, you should be suspicious of any investment that is popular. As I've said before, you must be fearful when others are greedy, and greedy only when others are fearful. This is the ultimate counterintuitive claim, but it's the very heart of successful investing. When everyone is euphoric, when taxi drivers are giving you stock tips, when headlines are proclaiming a new era where profits don't matter, that is the time for maximum.
Wayfair presents office furniture. With desks in every style, all under $199, you can save big, like a boss. Shop office furniture for way less at Wayfair.
Wayfair, you've got just what I need.
Caution. That is when Mr. Market is in his manic phase and prices are likely far above intrinsic value, there is no margin of safety. But when there's blood in the streets, when the headlines are filled with doom, when everyone is certain that the world is coming to an end, that is the time of maximum opportunity. That is when Mr. Market, in his depressive state, will offer you wonderful businesses, the castles with the moats for 50 cents, 40 cents, or even 30 cents on the dollar. Those are the moments that don't just make you money, they create generational wealth. But you can only act in those moments if you have the right temperament, if you've done the homework ahead of time, and if you trust your own analysis over the screams of the crowd. So, how do we put this all together? We've talked about the philosophy, the principles, the mindset. Let's make it concrete. I promised you a clear, actionable plan, a recipe you can follow. This is how you prepare so that whatever comes in October or any other month, you're ready. Step one, start making a list. Do it now when things are relatively calm. Don't wait for the panic. This is your businesses I'd love to own list. These are companies inside your circle of competence. Or spend your evenings and weekends reading. Read their annual reports, not just for 1 year, but for the last 10 years. Read the reports of their competitors. Is management honest and rational in their letters to shareholders? Do they admit their mistakes? How does the business make money? What is its moat? Is that moat getting wider or narrower? You are acting as a business analyst, a detective. Your goal is to understand a handful of businesses so well that you'd be comfortable owning the entire company if you had the money. Step two, for each company on your list, attempt to calculate a conservative estimate of its intrinsic value. Use the owner earnings concept we discussed. Be conservative with your growth projections. Be realistic about the future. You're trying to figure out what that farm is worth. You will end up with a range of values, not a single number. That's fine. Pick a conservative number within that range. Let's say you analyze a wonderful company and decide its intrinsic value is around $100 per share. Step three, demand a margin of safety. This is where you set your buy price. You will not buy this $100 per share value company for $95. That's not enough of a cushion. You decide that you will only buy it if you can get it at a significant discount. Maybe you set your price at $60 or $65. This is your magic number. Write it down. This step requires immense discipline. The stock might trade at $80, $90, even $110 for years, and you will do nothing. You will simply watch and wait. Step four, wait for Mr. Market to lose his mind. This is the hardest part. It could be months, it could be years, but eventually something will happen. A war, a pandemic, a credit crisis, a political shock, or just a good old-fashioned panic in October. The market will go down, and it will take the good companies down with the bad. Suddenly, your wonderful $100 value company might see its stock price fall from $90 to $70, then to $60. The headlines will be terrible. Everyone will tell you to sell, but you won't. Step five, act. When your price is hit, you buy. You don't dither. You don't ask for a second opinion. You don't wait to see if it'll go to $55. You have done the work. You know the value of the business. You know you are buying at a significant discount. You are being greedy while others are fearful. You act decisively and confidently based on your own prior research. And then comes the final step, which is almost as hard as waiting. You hold. You let the business do its work. You let it compound value for you over years and ideally decades. You don't sell it because the price goes up 20%. You don't sell it because some analyst downgrades it. You only sell if you believe the long-term fundamentals of the business and its moat have deteriorated, or if you find a dramatically better opportunity. Otherwise, your favorite holding period is forever. That is the entire plan. It's simple, but it is the polar opposite of what most people do. Most people get interested in stocks when they're going up. They buy high, fueled by greed. Then when the market turns, they panic and sell low, fueled by fear. They're constantly reacting to Mr. Market's mood. This plan allows you to do the exact opposite. You do your work in the calm, and you use the periods of fear and panic as your buying opportunities. And you turn the very thing everyone is afraid of, a market downturn, into your greatest ally. So what's really coming in October? I'll tell you, the sun will rise in the east, the tides will ebb and flow, and Mr. Market will show up at your door shouting a price. He might be happy, he might be sad, he might be terrified. For the unprepared, his mood will dictate their financial future. They will be swept up in the emotion of the moment, buying at the top and selling at the bottom, wondering why they never seem to get ahead. But for you, for the person who has done the work, who understands they own businesses, not tickers, who knows the value of their companies and insists on a margin of safety, for you, October is just another month. It's another 31 days to read, to learn, and to wait patiently. And if Mr. Market happens to have a terrible, fearful, panicky October, you won't see it as a crisis. You'll see it for what it really is, an opportunity.